The International Engine, a comprehensive guide to Vanguard Developed Markets ETF, VEA. As of January 30, 2026, the Vanguard FTSE Developed Markets ETF, ticker VEA, has emerged as one of the most vital tools for the great diversification of the mid-2020s. After a decade of U.S. stock market dominance, investors are increasingly looking beyond their own borders to find value, and VEA has become the default bridge to the world's most mature foreign economies. For an investor today, VEA is the S&P 500 of the rest of the developed world. It provides a slice of nearly 4,000 companies located in Europe, the Pacific region, and Canada. This 1,500-word guide breaks down why this fund is a cornerstone of global portfolios, its rock-bottom costs, and the specific geographic risks that distinguish it from domestic investments. 1. What is VEA? The non-US blueprint. VEA is designed to track the FTSE Developed All Cap ex-US index. To understand this fund, you must understand what it intentionally leaves out. The exclusions. No United States. VEA excludes all US-based companies. It is meant to be paired with a US fund like VOO or VTI to create a total world portfolio. No emerging markets. Unlike some international funds, VEA does not invest in China, India, Brazil, or Mexico. It focuses strictly on developed nations, economies with established legal systems, high per capita income, and mature financial markets. The full cap advantage. While many international funds only buy large cap giants, VEA is an all-cap fund. This means you own the massive conglomerates like Samsung and Nestlé, but also the mid-sized and small companies that often drive local innovation in countries like Japan and Germany. 2. Geographic allocation, where your money goes. In early 2026, VEA's geographic footprint is heavily concentrated in two major zones. Understanding these engines is key to knowing how the fund will perform. The top three anchors. Japan, approximately 20.5%. Japan is the single largest country in the fund. After decades of stagnation, Japanese markets saw a significant renaissance in 2025, driven by corporate governance reforms. Investing in VEA is in many ways a large bet on the continued health of the Tokyo Stock Exchange. United Kingdom, approximately 12.1%. The UK provides a heavy dose of value stocks, particularly in the banking, HSBC, and energy, Shell sectors. Canada, approximately 11.2%. Unlike some international indices, VEA includes our northern neighbor. This adds a strong layer of stability via Canadian banks and natural resource companies. The European core. Combined, countries like France, Germany, and Switzerland make up more than 50% of the fund. This makes VEA highly sensitive to the European Central Bank's interest rate policies and the overall industrial health of the Eurozone. 3. The top 10 holdings, global household names. If you look at the top 10 holdings of VEA in 2026, you will recognize most of the names, but they represent very different industries than the US Magnificent Seven. ASML Holding Netherlands, the world's most important semiconductor equipment maker. Samsung Electronics South Korea, a leader in consumer tech and memory chips. Roche and Novartis Switzerland, global pharmaceutical powerhouses. AstraZeneca UK, a biotech and vaccine giant. Nestlé Switzerland, the world's largest food and beverage company. Royal Bank of Canada, one of the most stable financial institutions on earth. Sector concentration. Unlike the tech-heavy US market, VEA is led by financials, approximately 24%, and industrials, approximately 18%. This makes it a value-leaning fund. When tech stocks are crashing, VEA often holds its ground because people still need banks, medicine, and food.
4. Cost and efficiency, the 0.03% benchmark. Vanguard is famous for its low costs, and VEA is one of its loss leaders. Key statistics as of January 30th, 2026. Expense ratio, 0.03%. This is effectively free. For every $10,000 you invest, you pay only $3 per year. This is roughly 90% cheaper than the average international mutual fund. Dividend yield, 3.1%. International companies historically pay out more of their profits as dividends than U.S. companies. In 2026, VEA remains an attractive choice for income seekers who want a steady quarterly check. AUM, assets under management. With over $268 billion in assets, VEA is incredibly liquid. Whether you are buying $100 or $100 million, you can get in and out at a fair price instantly. 5. VEA versus VXUS versus VWO. Which one do you need? New investors often get confused by Vanguard's international lineup. In 2026, the distinction is clear. VXUS, Total International. This is the everything fund. It includes everything in VEA plus emerging markets like China and India. It is for the investor who wants to buy the whole world, ex-US, in one click. VWO, Emerging Markets. This is the aggressive fund. It only buys developing nations. It is high risk and high reward. VEA, Developed Markets. This is the middle ground. It offers the safety of mature economies without the extreme volatility of emerging markets. Many investors use VEA as their core international holding and then add a smaller slice of VWO on the side. 6. Critical risks. Why international investing is different. Even with Vanguard stability, VEA carries risks that you won't find in a US fund. Currency fluctuations. This is the hidden risk. VEA is unhedged. If you buy VEA and the euro or yen gets weaker compared to the US dollar, your investment will lose value, even if the stocks themselves stayed flat. Conversely, if the dollar weakens, your VEA returns get a bonus boost. Geopolitical proximity. Being heavily invested in Europe means being sensitive to regional conflicts and energy crises. The 2024-2025 energy shifts in Europe directly impacted the industrial component of VEA's portfolio. Slower growth profile. Developed markets, Japan, Europe, have aging populations. They do not typically grow as fast as the US or emerging markets. VEA is usually a bet on stability and yield rather than explosive growth. Taxation. Foreign dividends are subject to foreign tax withholding. While you can often claim a foreign tax credit on your US tax return, it adds a layer of complexity to your annual filing. 7. Investor strategy. Building the 2026 global barbell. Financial advisors in 2026 generally recommend a 20 to 40% allocation to international stocks. The Rebalancing Act. For the last decade, the US VOO has outperformed the world VEA. However, in early 2026, valuations in the US are near historic highs, while VEA is trading at a discount, PE ratio of 15x versus the S&P 500's 23x. The income shield. If the US enters a recession in late 2026, VEA's higher dividend yield and exposure to old economy sectors like banking and healthcare may provide a much-needed buffer for your portfolio. A note on IRAs. If you hold VEA in a Roth IRA, you cannot claim the foreign tax credit. Many experts suggest holding VEA in a taxable brokerage account to ensure you can get that credit back from the IRS while keeping your high-growth US stocks in your IRA. Conclusion. The essential international diversifier. The Vanguard FTSE Developed Markets ETF, VEA, is not the exciting part of a portfolio, but it is one of the most important. It protects you from the risk of the US economy underperforming and gives you a stake in the global leaders of industry, finance, and healthcare. The verdict. If you want a low-cost, high-yield, and incredibly broad way to own the world's most stable economies outside the United States, VEA is the industry standard. It is the perfect set-it-and-forget-it tool for building long-term global wealth.